On the handle, really, so to speak, Vidyashankar Krishnan, the VC and MD at Forgings, joining us on the show. And we also have with us on board Sunil Bohra, the ED and Group CFO at Minda Industries, joining in. Gentlemen, morning. Just help us understand, Mr. Krishnan, if I could start with you first. When it comes to domestic tonnage, that's been on a downslide and unstable export demand. How exactly has your business been impacted by the multitude of headwinds that one is seeing? And are you really witnessing any green shoots in sight, or do you think they're still a very long time away?
About 30% this year, inescapably. The domestic CV market has really tanked. What with the axle load norms, GST reducing transit times for long-distance vehicle transportation, and improvements in efficiency, coupled with the NBFC crisis, altogether demand has been pretty bad, and we are down by about 30% this year. And the saving grace is 30% because of our presence in exports. Otherwise, the slide in the Indian CV market itself is to the extent of about 60%. It's been really brutal.
Yeah, that seems to be the case. Sunil, with PV figures showing signs of bottoming out, tell us a little bit about the uptick that you're seeing on the orders front and whether that's beginning to take place in a big manner. Has there been any incremental change in terms of order inflow that you witnessed?
Yeah, I think in last 12 months, after a precipitous fall, which we have seen month on month in the volumes, fortunately, in last couple of months, things have started to stabilize, and we expect that trend to continue in this coming quarter from January to March. But as your colleague rightly said, Tarun, earlier, that with the BS6 launches around the corner and the price impact, which is already visible of around 10%, as of now, it's very difficult to guess how the markets will pan out from 1st of April. But yes, there are green shoots in terms of uptick in few of the OEMs, but overall we expect this quarter, which is the current quarter of quarter 4 from January to March, to be a tad better than Q3, with the green shoots coming mostly from the PV. Two-wheelers also we are seeing some traction, but yes, the stability there looks like a bit of a lag, but we expect that two-wheeler market also to stabilize soon.
What exactly do you think are the steps taken to offset the impact of the CV down cycle? To what extent has diversifying helped?
Diversifying, we've always been a major exporter. In fact, we have diversified into the domestic CV market recently, or increase our presence over there. And after about 12 months of a good run, I think we're seeing a huge fall since the last more than 12 months, particularly so in the last 6 months. I would say this play would take another 12 months to pan out, and we should see some movement by Deepavali of this year.
What really is the chatter on ground? Because, there are a couple of new products that you've also launched for the two-wheeler segment in particular. Are they really higher margin products versus the current overall margins? And do you really think that, that's the only way forward? Because by the end of it, your focus is also on profitability. Sunil?
Is this question to me?
Yes, Sunil, for you.
Yeah. So we are in the process of launching the major two-wheeler edition, which is the alloy wheel, which will get commercial production from April. As of now, we are under construction of that plant. That will increase our kit value substantially. In terms of profitability, yes, we do expect overall returns on capital employed to be broadly in line with our current returns, and that is going to be a big addition. On top of two-wheeler alloy wheel, there will also be addition. There will also addition of Harita, the Merger process is at the last stage, and we do expect the approval from the courts very soon. And that will again add a significant kit value to our two-wheeler portfolio specifically, because half of the Harita seating is in two-wheeler and half is in CVs and off-roads. So in terms of two-wheelers, yes, you are right, these two products will be significant addition to our kit value, and both we will start seeing impact from the first quarter of the next fiscal. And in terms of overall return, yes, both the products, we expect our overall return of capital employed to be in line with the group average, while on a EBITDA basis, we all know that Harita has a little lower EBITDA margin in the seating business, whereas in terms of alloy wheel, we do expect margins to be little above our overall average, but there the fixed asset turnover ratio is little less, and that's why the overall returns which we expect from both these product additions to be in line with our group average.
Sunil, the question which I'm asking everyone is that there are two disruptive waves which are there in the manufacturing space. One is 3D manufacturing and second is electric vehicles. In your case, it could be electric bikes. How are you preparing your company to tackle this kind of a disruption? And when you talk to your buyers, which is OEMs in this case, are you getting a sense that they are also looking at retooling the plants completely? Because if they have to retool their plant, they will ask you also to retool your product offering.
I think fortunately, yes, EV is a big opportunity for us. But if I take a step back, if you see most of our products, we are having 30 plus business lines, and barring the oil and air filters, most of our products are agnostic to the fuel injection systems, be it IC or EV. So most of our products are required actually in both the vehicles, be it an internal combustion engine or it will be a EV engine. So from our existing product portfolio, we are well placed and we don't see any significant headwinds in any of our products barring one or two products. That's on the existing business. Yes, in terms of EV, yes, it does gives a big opportunity for us to enter into fewer more products, which we currently are working on. At this stage, it will be difficult for me to give details about those, but our teams are consistently working, and we do expect addition of a couple of products specifically for EVs in next 6 to 12 months.
So one more follow-up question, Mr. Krishnan. You said that the uptick will come around Diwali, which means what you are indicating is that for next 9 months, we are in for more of the same, which is a struggle at the CV space will continue and the nature of the headline will not change. You're not painting an optimistic outlook, I'm afraid, sir, but I'm glad you're being realistic here.
I would love to be optimistic. My estimates range between June and November. The reason is as follows. April up to March, we have a tad of a pre-buy like condition with BS6 coming in from 31st of March, from 1st of April onwards. So CV buyers are queuing up to get what they can in a little way better than the last 3-4 months. And CV manufacturers have all pruned down their inventory to bearable levels. So up to 1st April, we will see pre-buy for BS6. From April, May, June, these are traditionally dull months for the CV market. On top of this, we will see this pre-buy and an overall low cyclical structural, as you wish to call it. So May, June, April, May, June is also likely to be a very dull quarter. Things should start picking up from June onwards, when base demand should start to kick in. See, basically, in July 18 have changed the game. It has added in almost 2 years of production capacity into the truck market by increasing the haulage of the trucks that are available on the roads of India. That cannot be wished away overnight. There will be pain associated with that move. And hopefully the government brings in a credible and a substantial policy for scrappage of CVs. That should really enthuse the market.
Policy is coming, Mr. Krishnan, that's what we understand. Let's assume that the scrappage policy, what is there in the public domain, that's actually rolled out next 3 months before June. What changes for you?
See, going back in history, assume that the package is for a for replacement of vehicles 20 years old. In 2000, about 2000, we produced as a country 250,000 CVs. I'm guessing that 20% of those were LCVs. So we're looking at 200,000 M and HCVs that ought to be phased out. So that makes a huge impact even at a 20-year level. Now, if the cutoff is 15 years, or as we go forward by 5 years, in 2005, we produced around 350,000 CVs in the country, giving a greater percentage of that production to LCVs, because LCVs have slowly caught up. I would expect M and HCVs again in the region of 250,000 plus. So that is the level of M and HCVs that will be phased out from the market, from the roads of India. That adds, in today's terms, that is almost 100% load to the current demand seen by CV makers. That's a huge impact.
Gentlemen, great to have you both on the show, and we sincerely hope that 2020 finally brings some respite at least, and sooner than later, for the industry.
Thank you. Thank you.